Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing MP Materials stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. MP Materials is a rare earth materials company. It is headquartered in Las Vegas, Nevada, and was founded in 2017. It went public in 2020 and currently trades on the NASDAQ. It owns and operates the Mountain Pass Mine, the only operating rare earth mine and processing facility in the US. It focuses on producing neodymium, praseodymium. That's a rare earth material used in high-strength permanent magnets that power EVs, robotics, drones, and other advanced motion technologies. As the EV market gets bigger, this company should also get bigger. Let's get started with the model. This is a mid-cap company, 5.9 billion market cap. They're trading at $34 a share, and they have 171 million shares outstanding. Let's look at the financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. So you can see they only have 2 years of financials, and both they have negative free cash flow. Net income is the profit and loss on the income statement. It's revenue minus expenses. That's also negative in both years. Revenue is the sales for the company, and that almost doubled from 73 million to 134 million. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. The difference between those two numbers is their gross profit. They really lowered their cost of revenue. It only went up $6 million from 2019 to 2020, while their revenue nearly doubled. So they had over $60 million of gross profit in 2020. Below that is operating expenses. Examples are research and development and depreciation. Then below that is their operating income. It's really impressive they have positive operating income so soon. Below that is the interest they pay in their debt. Then other income and expenses. This is usually impairments or write-offs. Since they had such a big negative in other income and expenses, they have negative net income in 2020, also negative in 2019. This is the company statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. You could think of operating cash flow as net income converted to cash, because net income is your accounting profit and loss. It's not actual cash. That's really good. They generated over $3 million of operating cash flow. Then you have capital expenditures, which are investments in property, plant, and equipment. This company spent over $20 million in CapEx in 2020 because they're trying to grow their business. That's why they had negative free cash flow in 2020. The amount they spent in CapEx was more than the cash they generated from their operating business. They had negative $3 million in 2019 and negative $19 million in 2020. When the company IPO'd, that gave them a cash injection of $544 million. They're using that cash to grow the business. They're also adding a little debt. They added $39 million in 2020, but they paid down $20 million. So they increased their debt $18 million in 2020. They decreased their debt $4 million in 2019. Let's look at the capital structure. $854 million of equity, $71 million of debt. They're 92% equity, 8% debt. Their net debt is negative $449 million. Because they have so much cash in their balance sheet from their IPO. Their WACC is 13.75%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $3.3 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $2.4 billion. We divide that by 171 million shares. And we get a calculated stock price of $14. They're trading at $34, so they're trading at a 141% premium. It's a sell according to the model. Simply Wall Street is a little higher than me. They're at $23 a share. They're also saying the stock is overvalued. Three analysts priced this stock in the past 3 months. The average price target was $48. The low was $37, the high was $57. So my valuation is much lower than them. So it's really hard to value a stock like this. You have to estimate how big the market will be, what percent this company will have that market, as well as their expenses. Obviously, the stock price could go way up without the company making any money. I try to value a company on their expected future free cash flows, which is a lot harder to do than pricing a stock. A lot of analysts price a stock just where they think the price will be, not what the company is actually worth. So this stock has done really well since it IPO'd. It looks like it pretty much doubled. With the whole EV craze, this stock could go a lot higher. This stock went up 243% in the past 52 weeks, while the S&P 500 went up 60%. The 52-week low was $10, the high was $52, and the stock is trading above its 200-day but below its 50-day moving average. This is a really liquid stock. 6 million to 13 million shares are traded each day. Of the 171 million shares outstanding, 73 million are on float, 64% are held by institutions, and 4.35% of the shares are shorted. In the past 30 days, this stock has gone down 18%, while the industry went up 5% and the market went up 1%. But in the past 90 days, this stock has gone up 5%, the industry has gone up 12%, and the market 5%. Analysts are forecasting their earnings to grow 74%, while the industry is 17% and the market 19%. The forecast on their revenue is to grow 26%, the industry 6%, and the market 10%. If you invested $10,000 into this company when it IPO'd, you'd be at $34,000 today. That's a 315% annual return. The biggest shareholders are JHL Capital at 26%, then QVT, then the CEO of the company, then Shang Resources, and the last is Vanguard. Let's look at their financial ratios. The average PE in the market's 32, the median is 22. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so we can't look at the PE. Price to sales is stock price over sales per share. They have a really high price to sales ratio, almost 44. That means investors are paying $44 for $1 revenue. Price to book is stock price over book value per share. They're at 6.9. That's between the median and average. Their return on invested capital is 6.3%, and their WACC is 13.7%. That means every dollar they borrow through debt and equity, it costs them 13.7 cents. And when they invest that money back into their company, they only make 6.3 cents. So they lose 7.4 cents every dollar they put into their company. This number is bound to improve over time as they grow and become more efficient and profitable. Interest coverage ratio is EBIT over interest expense, so they can cover their interest payments 6.5 times. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They can easily cover their current liabilities with their current assets. And their current assets are mainly cash of over $500 million. And the company is well capitalized. They did have negative free cash flow, but they have a ton of working capital from their IPO. So they have $500 million of funding. The best way to look at ratios is to compare them to companies in the same industry. I've done videos on American Battery, BHP, and Tech, all in the same industry as MP. And if MP has a number in red, they're worse than the average. If they have a number in blue, they're better than the average. So they're worse in all the price multiples. They have the highest current ratio of other companies. They're not doing well in ROE. They're the lowest in debt of all the companies. Their market cap is lower than average because BHP is so big. And they don't pay a dividend, just Tech pays a dividend. To summarize, I have them trading at a 141% premium, but this company could be really huge one day. But there's so many companies in the EV market, it's just really hard to figure out which company to put your money on. I rank their free cash flows 1 out of 10, their revenue 5 out of 10, and their ratios 2 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.